This is Nightly Business Report with Tyler Matheson and Sue Herrera. Funded in part by...
All it takes is a spark. One idea to take flight. The courage to seek the unknown. To innovate, disrupt, to move us all forward. To explore a different perspective. At NASDAQ, we connect the world. Its ideas, its capital, its businesses, the people that drive global economies. The future isn't tomorrow, it's right now. All it takes is a spark. NASDAQ.
Setting the stage, job growth defies expectations and wages rise. Now it's the Fed's turn.
Where the jobs are, one industry where hiring might be accelerating to full throttle.
The accidental landlord. They didn't plan on changing the way office space is rented, but they did. And their bright idea turned into a growing business. Those stories and more tonight on Nightly Business Report for Friday, March 10th.
Good evening, everyone, and welcome to the end of the week. Well, it is official. The American economy created a lot of jobs in February, many more than expected. The gains were broad in sectors all across the economy. The employment rate did tick lower. Wages moved up now at the second highest year-to-year rate of the current economic expansion. Here are the numbers. For the month of February, non-farm payrolls increased by 235,000. The unemployment rate now stands at 4.7%, a level very close to what the central bank considers full employment. And average hourly earnings, they were up 0.2% from the prior month, but 2.8% from a year ago. The report comes just days before Federal Reserve officials make a big policy decision, and Hampton Pearson reports.
February job gains were widespread, with construction leading the way with 58,000 new hires, and manufacturing producing its biggest monthly gain in 2 years, adding 28,000 new workers. Healthcare also continues to be an engine of job growth. And it's the first jobs report covering a full month under the Trump administration. A top economic policy official says it's just the beginning.
When you look at what we've been doing here at the White House and all of the CEOs that we've brought in, whether it be Exxon or Sprint or Intel, they've promised an enormous amount of jobs and job creation in the United States. Those hirings have not been done yet. Those are future hirings.
Other signs of momentum, a slight dip in the unemployment rate to 4.7%, more people working or looking for work, producing the best labor force participation rate in nearly a year.
One of the gains we saw in employment was in private education, which includes training by employers, which was very interesting to see that. That's something that's been absent much of the recovery.
Today's jobs data almost guarantees a rate hike when the Fed meets next week. And leading economists say with wage growth accelerating, the odds for 4 rate hikes this year are increasing.
If we get these kinds of reports, this kind of economy, I believe the Federal Reserve will raise at every press conference meeting this year. Unless we have some crisis. So that would be 4 rate hikes, not the 2 the market is pricing in.
They've begun to accelerate, and it's sort of a Goldilocks way. They're not accelerating to the point to where we're worried about inflation creeping in, but they are accelerating to the point to where it puts more money in people's pockets and increases the willingness for them to spend that money.
More signs of a stronger economy. Late today, the New York Fed raising its growth forecast above 3% for the first quarter, citing stronger data on inventories, trade, and yes, jobs. For Nightly Business Report, I'm Hampton Pearson in Washington.
John Sylvia joins us now to talk more about February's better-than-expected jobs report, the Fed, and possible interest rate hikes. He is chief economist at Wells Fargo Securities. John, always good to see you. Welcome back.
Thank you, Sue.
So does this report kind of nail it that the Fed is going to move on interest rates and move them to the upside?
Yeah, definitely, Sue. It does really reinforce the idea that the economy has momentum. The labor market certainly is at or near full employment, as you reported just a minute or two ago. And the Fed does have a green light to move in terms of 25 basis points next week.
Do you think, as one of the sources in that piece of Hampton's just mentioned, that we might get as many as 4 interest rate hikes this year?
Yeah, Tyler, it is possible 4. We're only going with 3 in our view because I don't want to jump ahead of what the inflation numbers or the economic growth numbers could be. Yes, there's been an acceleration in terms of wage growth and inflation, but to get to that next level in terms of inflation, we're going to have a wait-and-see mode on that. So we're going with 3 rate hikes.
You know, you bring up inflation, and yes, wages did pick up again, and the participation rate, the number of people who were actively seeking jobs, that picked up. But at the same time, we've seen oil plummet, and some are bringing up the deflationary word again. How do those things balance out, do you think?
Well, first of all, Sue, it's very important to see the labor force participation rate picking up. That really tells you that workers or potential workers have confidence now that there are job opportunities out there. They're listening to the media, they're hearing stories, and now they're seeking jobs. Yes, the lower oil prices are going to be a nice offset. So once again, I would say lower oil prices, probably maybe 3 rate increases, but going 4, I don't think you have the inflation numbers to justify 4 rate increases.
I love the irony that about a year ago, the job report was roughly similar to the one today, and candidate Trump hated it, said it was a disaster. This report, he says, or his representatives say, nearly perfect in terms of the numbers. Be that as it may, that's just the irony of the times and who's sitting where. Is it too early to give the Trump administration some credit for the business momentum that we seem to be seeing?
No, it's probably not too early to give them some credit, but we need to see that follow through, Tyler, in terms of are you actually going to get, and remember the market is discounting some movement in the corporate tax, some movement in terms of trade policy, some movement in terms of the Affordable Care Act reforms or replacement, call it what you want. So yes, we'll give them some credit, Tyler, but we need to see some deliverance of market expectations.
All right, on that note, John, thanks so much for joining us.
Thank you,
Have
Sue.
a great weekend. John Sylvia with Wells Fargo Securities.
And on Wall Street, stocks advanced following the strong jobs report, but some of the gains were lost midday as investors looked ahead to next week's central bank meeting. The Dow Jones Industrial Average added 44 to finish at 20,902. NASDAQ up 22, and the S&P 500 gained 7. For the week, the 3 major indexes were lower fractionally. The NASDAQ and the S&P 500 snapped their 6-week-long win streaks.
The Internal Revenue Service is challenging Caterpillar's taxes for the years 2007 through 2012. The Dow component, which is cooperating with authorities, says it disagrees with that challenge and that it stands by its financial reporting. As we told you, authorities raided Caterpillar's headquarters about a week ago in connection with an investigation into the company's offshore tax practices. And the New York Times earlier this week published a report, and that report accused Caterpillar of carrying out tax and accounting fraud.
Volkswagen pleaded guilty to 3 felony charges in connection with the diesel emissions scandal. The plea is part of the more than $4 billion agreement reached with the Justice Department in January. Under the deal, the automaker has agreed to new audits and oversight by an independent monitor. VW admitted to installing software on more than 500,000 U.S. vehicles that allowed them to beat or cheat emissions tests.
The numbers of vehicles recalled last year in the U.S. hit a record. The Department of Transportation said automakers recalled more than 53 million cars and trucks. Part of the reason was the massive callback to replace Takata airbag inflators.
Still ahead, creating jobs by rebuilding America's military.
I'm Kate Rogers in Pascagoula, Mississippi. Tonight on Nightly Business Report, we'll tell you why defense manufacturers like Huntington Ingalls may be set for a Trump bump.
The equivalent of more than 1 billion barrels of oil have been discovered in Alaska. That's the biggest onshore discovery in the U.S. in 30 years. The find could help shore up Alaska's budget, which has been hurting lately because of the decline in production. The discovery was made in Alaska's North Slope, which was previously thought to be an aging, depleting oil basin.
The president has promised an increase in military spending, and that could result in more jobs, thousands of them. Kate Rogers takes us to Pascagoula, Mississippi, and inside the operations of America's largest military shipbuilding company.
From land to the sea to the sky, President Trump is promising to beef up the American military to the tune of $603 billion. That marks a $54 billion budgetary boost in defense spending.
It will be one of the greatest military buildups in American history.
Among one of the top priorities, building up the Navy, growing the nation's fleet to 350 ships from the current 274. For military shipbuilders like Huntington Ingalls, General Dynamics, and their suppliers, this potentially means more business and more jobs.
We're seeing the market for shipbuilding is improving. We started investing in the facilities a couple of years ago to create the space for these folks to work.
Even based on the Navy's current plans that don't include President Trump's ambitious proposal, Huntington Ingalls is looking to hire 4,000 people in the next 3 to 5 years.
We have dozens of crafts that are involved in the building of the ships. It's pipe fitters, it's welders, painters, insulators, just about anything you can imagine that you might need in building a city. We use because, frankly, that's what we're building.
26-year-old Jeffrey Kofer is training in Huntington Ingalls' apprentice program. A National Guard veteran of the Iraq War, Kofer has been in the program for 3 years, working up to his 8,000-hour requirement for pipe fitting.
The best part about it is the opportunity to learn a trade, something I didn't have before.
Kofer is spending time in the classroom learning everything from basic math to naval architecture and working in the shipyard. Entry-level workers here can earn up to $57,000 a year, plus overtime and benefits.
We move around the yard, we see different stages of ship construction.
If the president's proposals come to fruition, industry workers will have opportunities for years to come. But to get what he wants, President Trump will need buy-in from a divided Congress.
A pretty significant expansion of military procurement as well as manpower is probably in store. I think it's going to be difficult for him to get what he wants. So there is a fight coming.
Companies like Huntington Ingalls rely heavily on the orderly flow of work from one ship to the next, and CEO Mike Petters hopes that changes in Washington will at least bring an end to the defense sequester that currently caps spending until 2021 and has been a strain on operations.
Let's get back to the process of creating budgets and establishing priorities and allocating resources to those priorities.
Congressional fight or not, shipbuilders like Kofer will be ready for action.
I'm very honored and very proud to be a part of it. I know what it feels like to be on the other end of equipment built by American workers.
For Nightly Business Report, Kate Rogers, Pascagoula, Mississippi.
And to read more about hiring at defense contractors, you can head to our website, nbr.com.
Vail Resorts shreds its estimates, and that is where we begin tonight's market focus. The ski resort operator said an increase in customers, particularly at its Whistler and Park City locations, lifted quarterly profit and sales above expectations. The company also raised its quarterly dividend 30% to more than $1 a share. Vail up more than 4% on the day to $188.89. And Southwest Airlines sees some dark skies ahead. The airline lowered its outlook for operating unit revenue, saying unexpected softness would cause a drop of as much as 3% in the first quarter. Southwest down 48 cents at $55.88. And the specialty apparel and footwear retailer Genesco said weakness at its teen retailer Journeys resulted in overall revenue that fell short. But the company's profit did improve. That's thanks to a strong holiday shopping period. And that sent shares up 8% to $61.30.
Shares of fiber optic cable maker Finisar were lower after the company posted disappointing results late yesterday. Finisar's guidance for the current quarter was also weak, and the shares plunged today 22% to $26.98. Retailer The Buckle, which sells brands such as Oakley and Billabong, said a challenging retail environment caused revenue, profit, and same-store sales to fall. The results were below the company's guidance, as well as Wall Street's expectations. Nonetheless, the shares picked up momentum, rising nearly 3% to $17.80. And Zumiez, which sells skateboards and apparel, beat both profit and sales expectations after the bell yesterday, but shares still got crushed today. The company forecast a loss for the current quarter that was much larger than what Wall Street was expecting. The shares fell 12% to $18.40.
And now to our market monitor. Who likes home builder stocks? The sector closed up for the 5th straight week. That's the longest win streak it's had since August. There you see it, up 16% over the past year. Chris Bertelsen is President and Chief Investment Officer at Aviance Capital Management. Chris, welcome back. Good to have you with us. I hope I pronounced Aviance correctly. Did I?
You did, Tyler. Thank you.
You know, one of the bright spots in the jobs report today was construction hiring, which suggests that the home builder and building sector is moving ahead. It is absolutely consonant with what you're recommending. Let's start with your first pick, D.R. Horton. Why do you like it?
I think D.H. Horton really is terrific. They are mid-level type of home builder. They are great at creating jobs, not only for skilled trades workers, but for semi-skilled as well. And they have inventory which is basically bought back in 2011, 12, and 13, plus the fact they're 35% discount to the market. So they're about as cheap a sector as you can find, breaking up. And D.R. Horton is breaking out from its 2013 old highs, and good timing.
All right, Lennar is next on the list, and you say it's similar to D.R. Horton, but they did something interesting during the financial crisis. They reinvested in their raw commodity, which was land.
Absolutely. That's the one item on a home builder's balance sheet is really their land. So now they've got big built-in profit. They bought WCI here in Florida, and they do a little more rental, but pretty much a carbon copy of Lennar. Again, very cheap, strong balance sheet. You got to like them.
And the last one is sort of a step up in terms of the sort of house price price point at which they do business, and that is Toll Brothers. Why do you like them?
Well, Toll Brothers certainly is for the upper end buyer. They are big in country clubs and high-end communities. You have to like Toll Brothers because that is one of the fastest growing segment. As we see baby boomers retire and those that have earned substantial money over a period of time, they like the Toll Brothers communities and I think therefore attracted to the high end, although a smaller segment of the market.
Right. How do you view the housing market itself right now, Chris? Because, you know, we hear that there's a shortage of first-time buyer or entrance-level types of homes out there, but demand is pretty good from what we've been hearing. What do you see?
Yes, there's no question that the first-time home buyer at the lowest levels sort of sets the market. But I think this is the one area where policy in Washington from both sides of the aisle want to see a public-private partnership if you'll have it. So I think you'll see even incentives and stimulations for what you would consider starter and beginning homes and things at the low end of the price range.
Can you find me a nice place in Sarasota, Chris?
Come on down.
How's it going? Let me ask you a serious question. Do you expect that people will get off the fence and go into the real estate market because interest rates are moving up? Is this going to hurry them up?
There's no question that that's a stimulus. But we fast forget that we had building booms when we had 4% and 5%. Mm-hmm. Now, I'm not saying we're going to get there in a hurry, but we certainly look like we're marching in that direction.
All right, Chris, I'll see you in Sarasota. Chris Bertelsen, Aviance Capital Management.
And coming up, Headquarters on Demand, the story of two entrepreneurs and their bright idea to help support other businesses.
A lot happens on Wednesday next week. In fact, take the rest of the week off. You don't need to bother with it. Here's what to watch, folks. The Fed will release its decision on interest rates and host a press conference Wednesday. As we reported, the central bank widely expected to raise rates. That same day, the president's new pick to lead the Labor Department will have his confirmation hearing. And Wednesday night at midnight, the debt ceiling extension expires. That means the Treasury cannot borrow any new money. I hope they'll get a solution to that. That's what to watch next week.
The hotel business is going after Airbnb. A study funded by a hotel industry group says the home-sharing startup is running illegal hotels. According to the American Hotel and Lodging Association, whose members include the likes of Marriott and Hyatt, as well as others, Airbnb is able to avoid regulations and offer lower prices, oftentimes renting out entire homes, not just rooms. Airbnb calls the report inaccurate and misleading.
Working spaces are continuing to change. Open layouts, social areas, multiple companies sharing real estate. They're all pretty common now. But two New York City entrepreneurs, both with tech backgrounds, got the bright idea to change the way leases work, not only by increasing flexibility for renters, but also for building owners. When Amal Sarva and Edward Shenderovich began renting out their extra New York City office space a few years ago, they didn't think it would turn into a business called NoTell.
NoTell started by accident. We were sitting on top of an explosively powerful business.
Powerful? In just 15 months, Sarva says NoTell's brought in about $10 million, but starting it meant taking on multinational, multi-billion-dollar companies.
Started looking at their numbers and trying to understand whether we actually had something unique to offer.
Two of the big boys renting office space are WeWork and Regus. 6-year-old WeWork develops co-working spaces mostly for smaller startups and individuals looking to share the cost of kitchens, social space, Wi-Fi, even group health insurance. Regus, in business for more than 25 years, used to target big businesses. Now it's aiming for other segments as well, with 3,000 locations across 120 countries. But Sarva and Shenderovich believe there's a giant underserved market. Newer, faster-growing companies with 20, 30, maybe 50 employees.
Less than 1% of the office market is this co-working type stuff. 99% is companies that need a headquarters.
Startups tend to begin life as nomads. 5-year-old Venue Book, an event space booker, is in its 7th office.
We have our first sign.
Brand identity is a plus, but Kelsey Recht says NoTell's flexible 1-year lease allows Venue Book to move again if necessary. NoTell says space for 20 runs about $10,000 a month in New York City.
We didn't want to sign a really large lease and then have to sublet to another company.
To NoTell, leases are the enemy.
Leases are what you thought was the only way to do business up until someone showed you a different way.
Sarva and Shenderovich say long-term leases, 5, 7, 10 years, hurt small businesses and landlords. If average rents rise during the lease, landlords can't cash in. NoTell helps landlords turn over their spaces more often, letting the market dictate the price the same way hotels change room rates day to day. NoTell shares the risk with landlords and collects a margin off the top.
That was really a problem for a building owner because you can't really run a building with your leases turning over every 6 months. And I think NoTell took care of that.
30-year commercial real estate veteran Norman Curlin is the landlord who first pushed Sarva and Shenderovich to fill extra space they were renting from him.
It's not really a traditional sublease operation. It's more of a moving around the companies as they needed space.
Sarva and Shenderovich also believe their tech backgrounds will help landlords adapt into the future. Who knows what the conference room will look like in 10 or 20 years?
We'll provide them as a service that alleviates the necessity for them to become experts in technology. And for residents, we alleviate the necessity for them to become experts in real estate.
You have to coordinate different people's needs over time that change. Now that we have technology, we can coordinate their needs and put them together.
NoTell has 15 locations in New York City now, but with $25 million in new investment capital, it is expecting to expand outside of New York and total about 40 locations by year's end. Already expanded beyond tech startups, its client list now includes media, finance, fashion, and retail companies. Good business working.
Good business, yeah. All right, that will do it for us on Nightly Business Report tonight. I'm Sue Herrera. Thanks for watching, and we want to remind you this is the time of year your public television station seeks your support.
I'm Tyler Matheson, and we all thank you for your support. Have a great weekend, everybody, and we will see you back here on Monday.
Nightly Business Report has been funded in part by...
All it takes is a spark. One idea to take flight. The courage to seek the unknown. To innovate, disrupt. To move us all forward, to explore a different perspective. At NASDAQ, we connect the world, its ideas, its capital, its businesses, the people that drive global economies. The future isn't tomorrow, it's right now. All it takes is a spark. NASDAQ.